The money in your bank account doesn't actually exist. This isn't a metaphor, and it's not conspiracy theory. If every account holder walked into their bank tomorrow to withdraw all their money, the system would collapse within hours because the money physically isn't there. This is how the global financial system is designed. It's a method so old and so deeply entrenched that we humans have come to accept it as normal. It's called fractional reserve banking. And this system is the silent engine behind global debt, inflation, and the illusion of wealth. Once you understand how it works, you'll realize that money itself is built on promises that can never truly be kept. This story goes back a long way. In medieval Europe, money meant gold and silver. If you were wealthy, you had coins or jewels you could trade, but traveling with bags full of gold was equally dangerous. People began leaving their valuables with goldsmiths. Goldsmiths had secure vaults. In return, the goldsmith would give the owner a receipt, a simple piece of paper, a document promising that the bearer could return and collect their gold. Before long, people realized they could trade these receipts instead of the gold itself. The paper represented the value just the same, and it was easier to carry. This is where the trick was born. The goldsmiths noticed something. Almost no one came to claim their gold at the same time. If they had deposits from 100 customers, maybe 1 or 2 people would come to withdraw money on any given day. The rest of the gold sat motionless in the vault. So the goldsmiths did something clever. They began issuing more receipts than the gold they actually held. If they held 1,000 coins, they could issue 2,000 receipts. They could lend these extra receipts at interest, profiting from gold that didn't exist. As long as everyone didn't demand their coins at once, no one noticed. Essentially, money was being created out of thin air. This wasn't just a clever side hustle, it was revolutionary. The moment people accepted paper claims as valid as gold, money creation broke free from physical reality. Banks emerged from this practice and institutionalized the trick. In the 17th century, governments themselves embraced this system. The Bank of England was founded in 1694 not to serve the public, but to solve a problem. The crown was drowning in debt from endless wars. The bank lent the government far more money than it actually held in reserves. In exchange, it received interest payments. The debt was repaid not with treasure from new conquests, but with the taxes of ordinary Englishmen. Sound familiar? Because the mechanism governments use today is the same. Borrowing money that doesn't exist, then paying it back by taxing future generations. The United States followed the same path. Early American banks issued banknotes redeemable in gold, but they too quickly realized they could print more notes than they had gold to cover. Periodic bank runs exposed the illusion, panicked depositors demanding their money, only to discover it wasn't there. Banks collapsed overnight, yet the system wasn't dismantled. Governments doubled down. They created central banks to support the illusion. The message was clear: even if the money isn't there, we'll make sure the public keeps believing in it. Now let's explain this in today's terms, because fractional reserve banking is so abstract, it can feel like smoke. Imagine you walk into a bank and deposit $100. You think that money is waiting safely in your account. In reality, the bank is only required to keep a small fraction of it in reserve. In the past, this ratio might have been 10%. The bank would keep 10 and lend out 90. Someone uses it for grocery shopping. The shopkeeper deposits that 90 into another bank. That bank keeps 9, lends out 81. The money gets deposited again, lent again, and so on. By the time the cycle finishes, your original $100 has turned into nearly $1,000 circulating in the economy. But here's the catch. Only the first 10 actually exists as cash. The rest is debt. Every new dollar in the system is born as someone's obligation to pay it back with interest. If that shocked you, I have bad news. What I just told you is already an old story. Today in the United States, reserve requirements aren't 10%, they're 0. Since March 2020, the Federal Reserve hasn't required banks to hold anything against the deposits they take, not a single dollar. This means that neat multiplier that controlled how much banks could lend no longer operates. So if banks don't need reserves, what stops them from lending infinitely? Today the leash isn't reserve requirements, it's capital and liquidity rules. Rules set under a global framework called Basel. The Basel rules were created after a series of crises, especially after 2008, by central bankers and regulators meeting at the Bank for International Settlements in Basel, Switzerland, the institution known as the Central Bank of Central Banks. These rules aren't set by Parliament or Congress, but by technical regulatory institutions. Here's how it works. Banks must prove they have enough equity capital to absorb potential losses. The rules are complex, but imagine this. If a bank wants to make a risky $100 loan, it may need to hold $8 of its own money. Shareholder equity as a buffer. That's the real constraint. The more risky assets a bank takes on, the more capital it must hold. Additionally, banks must prove they have enough liquid assets to survive a short-term crisis. Cash, government bonds, things they can sell quickly. These rules are designed to prevent banks from flying too close to the sun. But notice what changed. Banks no longer lend from deposits. They create loans first, and loans create deposits. When you take out a mortgage, the bank doesn't pull cash from a vault. It writes new money into your account. That new money exists because you agreed to pay it back. Then the bank checks whether it has enough capital to cover the risk. That's why in the modern system, more than 90% of the money in circulation isn't central bank money, not cash or reserves. It's bank money created out of nothing the moment loans are issued. Think about that now. The money you see in your checking account isn't the same kind of money the Federal Reserve prints. It's money created by banks, born as debt. That's why the money supply keeps expanding as long as banks find borrowers. And that's why every financial crisis is actually a crisis of confidence. Because when borrowers can't pay, or when banks can't roll over debt, the entire system begins to unravel. This design creates 3 unavoidable consequences. First, inflation. Because banks multiply the same money into more and more credit, the value of each unit erodes. Prices rise not only from supply and demand, but from the dilution of the currency itself. Second, perpetual debt. Because money exists as a loan, there's always more debt in the system than money to repay it. Interest ensures the balance sheet never closes. Someone, somewhere, must default, refinance, or borrow more. Third, concentration of power. Banks collect interest on money they never truly possessed. Governments tap into this system to finance wars, welfare programs, and bailouts without directly raising taxes. And the wealthy, who own hard assets like real estate, stocks, and commodities, benefit as inflation pushes asset prices higher. Meanwhile, ordinary workers see their wages lose purchasing power. When this machine falters, the illusion cracks. Look at the Great Depression. In 1929, banks had lent far beyond their reserves, inflating a stock market bubble. When panic struck, depositors rushed to withdraw money, but the money wasn't there. Thousands of banks collapsed. The same thing happened in 2008. Banks had multiplied credit through mortgage-backed securities, creating a housing bubble based on the same principle. More promises than reality. When defaults spread, the system nearly exploded. Once again, governments and central banks stepped in. They pumped trillions into the system to keep the illusion alive. They saved the trick. Because without it, the modern economy cannot function. And this is where the global picture becomes important. In America, reserves are gone. In Europe, the United Kingdom, Canada, and Australia, reserve requirements had already become symbolic or non-existent. They all now rely on Basel rules. In emerging economies like China, India, and Brazil, reserve requirements still exist and are in double digits, and they're actively used to control credit growth. But even there, Basel capital rules sit on top, shaping how much risk banks can officially take. Wherever you live, the leash on money creation isn't the deposits in the vault. It's the regulations written in Basel, Switzerland. Here's the uncomfortable truth. The system can't afford for you to be debt-free. If everyone paid off their loans the next day, the entire money supply would collapse. Banks would have nothing left to lend. Economies would stop. The illusion depends on your participation, on your willingness to borrow, spend, and believe that the numbers in your account represent something real. You're both the fuel and the collateral. That's why history matters here. The mechanism medieval goldsmiths used to generate profit has been transformed into the foundation of modern finance, and the same dangers persist. Bank runs in the 19th century, the Great Depression in the 20th century, the global financial crisis in the 21st century. All the same reminder: when confidence cracks, the house of cards collapses. Yet each time the response is the same. Double down on the system, patch the illusion, and move forward as if nothing happened. So what should you take from this? First, money isn't wealth. Real wealth isn't the numbers on a screen. It's land, resources, skills, knowledge, and independence. It's assets that hold value when paper promises dissolve. Second, debt isn't neutral. It's the bloodstream of a system that favors lenders, governments, and asset holders at your expense. Third, inflation isn't an accident. It's baked into the design. Every year you're asked to run faster just to stay in the same place. Does this mean inevitable collapse? Not necessarily. But it does mean you need to rethink your relationship with money. Accumulating cash in a bank account won't protect you. Blindly trusting the system won't free you. Building real wealth, things that survive outside the cycle of inflation and debt, is the only path to financial freedom. The lesson isn't paranoia, it's awareness. If your money is born as someone else's debt, then your freedom depends on stepping outside that machine. History doesn't repeat, but it rhymes. Medieval goldsmiths, 19th century bank panics, the 2008 housing bubble. All echoes of the same story. A trick that multiplies promises beyond reality, and a public that believes until belief becomes impossible. And make no mistake, this story isn't over. Every major financial crisis we experience is a reminder that the system's stability doesn't rest on gold or productivity, but on confidence. And confidence is a very easy thing to lose. The next time you look at your bank balance, remember, most of it only exists on paper, born from a debt system that wasn't designed with your freedom in mind. Understand the game and you can begin to protect yourself from it. Ignore it, and you'll remain just another player in a game where the house always wins.